Hi guys. Have a great day. This is through. I have done my MBA and worked as senior system engineer on various companies in last 7 years and got some interested in stock market. After lots of struggles, now I'm making reasonable profits. Welcome to our channel VVV FinServ, the path to financial freedom. We are creating this channel to share the knowledge what we have learned. Let's dive into video. A stock market is a place where people can buy and sell shares of ownership in companies. When you buy a share of stock, you are buying a small piece of ownership in that company. The price of a stock goes up and down depending on how much people are willing to pay for it. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. Why do companies issue stocks? To raise capital. This is the most common reason why companies issue stocks. When a company issues shares of stock, it is essentially selling a piece of ownership in the company to investors. The money that the company raises from the sale of stock can be used to grow the business, develop new products, or expand into new markets. To avoid debt. When a company issues stock, it is not taking on any debt. This can be a good thing for companies that want to avoid the high interest rates and other costs associated with debt financing, to attract investors. When a company issues stock, it is making itself more accessible to investors. This can help the company to raise more capital and attract high-quality investors. To create a liquid market for its shares. When a company's shares are listed on a stock exchange, it creates a liquid market for those shares. This means that investors can easily buy and sell the shares, which can make the shares more valuable. To align the interests of management and shareholders. When managers own shares in the company, they have a vested interest in the company's success. This can help to align the interests of management and shareholders, which can be beneficial for the company. How do stocks market work in India? The Indian stock market works in a similar way to stock markets in other countries. There are two main types of stock markets in India, the primary market and the secondary market. The primary market is where companies first issue their shares to the public. This is done through an initial public offering, IPO. When a company goes public, it sells a certain number of shares to investors. The money that the company raises from the IPO is used to fund its operations or expansion. The secondary market is where existing shares of stock are traded. This is where investors can buy and sell shares of stock that have already been issued. The price of a stock in the secondary market is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. Here are some of the steps involved in buying stocks in India. Open a demat and trading account with a stockbroker. Deposit funds into your trading account. Research stocks that you are interested in buying. Place a buy order for the stocks you want to buy. The stockbroker will execute your buy order and the shares will be credited to your demat account. You can then sell the shares whenever you want. How the stock prices and market value calculated. Stock price is the price at which a single share of a company's stock is currently trading. It is determined by supply and demand, with more buyers than sellers driving the price up and more sellers than buyers driving the price down. Market value is the total value of all the outstanding shares of a company's stock. It is calculated by multiplying the stock price by the number of outstanding shares. The market value of a company can be used to compare it to other companies or to measure its size in the stock market. It can also be used to calculate the company's market capitalization, which is the total value of its equity. The stock price and market value of a company can fluctuate over time, depending on a variety of factors, such as the company's financial performance, economic conditions, and investor sentiment. Risk and reward involved in stock market. The stock market is a risky investment, but it can also be a way to make money over the long term. Here are some of the risks and rewards of investing in the stock market. Risks. Market volatility. The stock market is volatile, meaning that the prices of stocks can go up and down quickly. This can make it difficult to time your investments and can lead to losses. Company-specific risk. The performance of a company can affect the price of its stock. If a company does poorly, its stock price could go down. Economic risk. The overall economic conditions can also affect the stock market. If the economy does poorly, the stock market could go down. Political risk. Political events can also affect the stock market. If there is a change in government or a major political event, the stock market could go down. Fraud. There is always the risk of fraud in the stock market. If you invest in a fraudulent company, you could lose all of your money. Rewards. Potential for high returns. The stock market has the potential to generate high returns over the long term. This is because the prices of stocks tend to go up over time. Diversification. Investing in stocks can help to diversify your portfolio, which can reduce your risk. Liquidity. Stocks are relatively liquid, meaning that you can easily buy and sell them. This can make it easier to take profits or cut losses. Control. When you invest in stocks, you have more control over your investment than when you invest in other assets, such as bonds or mutual funds. It is important to understand the risks and rewards of investing in the stock market before you invest. If you are not comfortable with the risks, you may want to consider other investment options. Summarize built-in points. A stock market is a place where people can buy and sell shares of ownership in companies. When you buy a share of stock, you are essentially buying a small piece of ownership in that company. The price of a stock goes up and down depending on how much people are willing to pay for it. The stock market can be a risky investment, but it can also be a way to make money over the long term. Some of the risks of investing in the stock market include market volatility, company-specific risk, economic risk, political risk, and fraud. Some of the rewards of investing in the stock market include the potential for high returns, diversification, liquidity, and control. It is important to understand the risks and rewards of investing in the stock market before you invest. Some tips for managing the risks of investing in the stock market include doing your research, diversifying your portfolio, investing for the long term, rebalancing your portfolio regularly, and not panic selling. Thank you for watching my video all the way to the end. I really appreciate your time and attention. If you liked this video, please subscribe to my channel for more content like this. Thank you for being a part of my YouTube community.